Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, December 23rd, 2020. This is the last full trading session of the week as we have a half day tomorrow, and of course we're closed on Friday for the Christmas holiday. Markets are doing what they do best, which is continuing to rally more or less despite the news flow that is presented to it. Let me do a little thought exercise. Suppose we said, after all this good feeling that came out about the stimulus bill and the government spending bill, don't forget that this is really about keeping the government open as much as it is about returning money to individuals. But suppose I told you, we have this deal worked out that everybody's been waiting for months, and there was going to be some real hijinks thrown in at the end. And I think you would think that the markets would not be rallying on the back of that. Now, if we unpack it, and there are several elements to it, essentially the market's calling the president's bluff, saying that, okay, he's used this kind of bluster before. He's not actually going to veto the bill necessarily. And so, this is more bluster, and we have this bill, and maybe the Congress can get together and even throw in some more money, as Speaker Pelosi has indicated. So, fine, we'll just deal with this. It's just one more piece of bluster. There are some interesting wrinkles here, though, and I suggest you read more about the pocket veto, because they're going to do. These sources will do a better job than I will. But it's just come to my attention recently, earlier today, that effectively the president has 10 days to sign a bill. And if he doesn't sign a bill, it's effectively vetoed. And normally the Congress could just, override his veto normally. But if Congress goes out of session during those 10 days, he technically can't return the bill to Congress, and therefore it becomes veto-proof. More or less, you have to start over again. And if this proceeds past the 28th, when the government starts to run out of money, you get a government shutdown, you get some real chaos. And as I mentioned, you don't have much ability to trade in that period. But why let those risks get in the way of the good story? And we saw futures more or less after an initial dip last night, starting to trade higher. They traded higher into this morning. Again, on what I would consider some mixed economic numbers, but certainly the market, chose the ones it wanted to respond to. And that would be that initial jobless claims, which, by the way, are lousy, as are continuing jobless claims, but they were more or less around the 800,000 jobs new claims number, as opposed to about the 880,000 number that was expected in the one that we saw last week. And so that was obviously considered a better than expected number, despite being lousy, especially if you're one of those 800,000 people, or one of the millions who have continuing claims. The problem you get into is, personal spending came out, and that was down 1.1%, and that was nowhere close to expectations. They were looking for down 0.3%. And consumer personal income, and then personal spending was minus 0.4 versus an expectation of minus 0.2, where you have two things going on there. That number, people obviously, if they're earning less, are likely to spend less, but they're still spending more than they earned. That's not sustainable. But again, why let the facts get in the way of good feeling? This is a momentum-driven market, and you could see that much more. The smaller the momentum-driven name you get into, the more obvious it is. It's a little less obvious when you look at some of the bigger cap names. It's quite a bit more obvious when you look at some of these smaller names that just sort of shoot up and down. I don't even have time for all of them, but I just, some examples would be Fubo, Edit. These are names that are not necessarily on people's radar, but they've had remarkable moves. Fubo was down a little bit today because an analyst actually questioned its valuation, and that hit the stock a little bit. Those names that I mentioned are illustrations. Obviously, I'm not recommending And I'm not recommending that people just follow blindly a momentum strategy, but it is one that's working for people. And when strategies work, people tend to do them. And that's, I think, applicable to the market and to the stocks, and which is why I think, getting back to our original point, markets were willing to shrug off the president's comments about the bill and about not being in favor of it, and just sort of thinking, okay, well, he's had a lot of bluster before, but he'll eventually come around. Time will tell. I perceive a bit more risk in this situation, I think, than the market does. That may be because that's just the nature of my trading life, which has always been to spot the risks that could upend our model. When we were trading the model, this is, the model worked except when really well, but exogenous factors would trip it up, and it was my job to figure out which exogenous factors could do that. This would be one of them, but at least for now, markets seem to be just figuring, we'd rather deal with a Santa Claus rally and assume that the president is bluffing, and so here we have it. I don't think we'll be filing one tomorrow for the half day, and I'm going to be taking a couple days off early next week, so we will be talking again next week. We'll see where we are when that comes down. Have a happy holidays, especially if you celebrate Christmas. And if not, we will talk again next week. Take care. Bye-bye.